Okay, hello everybody. Welcome to another session of Endowus webinars. Really excited to be here. I'm Sam. I'm the Chairman and Chief Investment Officer in Endowus, and this is another special session of Ask Your CIO. So we're going to try to make it fun and interesting, and also as engaging as we can. There's a lot of content. I was supposed to focus mostly on this hot topic of T-bills, fixed deposits, and Cash Smart and this stuff. And then obviously fixed income markets had a massive rebound. And so fixed income bonds became a very topic that many people wanted to ask about. And then obviously the Fed just raised interest rates again, and inflation numbers surprised on the downside. But the market has responded in a muted fashion. So I think there's a lot of questions about markets, macroeconomics, etc. So I try in the short, limited time that we have, try to do as much as we can and cover as much as we can. Special shout out to Kyungju and the investment office at Endowus who worked tirelessly to get all the slides ready. So thank you guys, and we're gonna get going now. So let's move into the slides. Just a quick disclaimer that we need to do, as we are an MAS licensed financial advisor as well as a capital market license holder. We're going to use Slido today again. So if you have any questions on anything that I cover today or anything that I don't cover, then please go to Slido and also upvote the other questions so I know which questions are going to be the most interesting and most important to you. One thing I really wanted to highlight, and this goes back to exactly what Endowus is really about and why we started the business and do what we do for our clients, but more broadly to our society, because I think especially in this season, we want to participate and give back to the community. We're working with a lot of charities, double the number of charities from last year, more than 20. We have some important partners here working with us as well. And this Endowus giving machine, as it's called, this is a vending machine that gives out charitable donation cards that you can go to Far East Square, Gardens by the Bay, Ion Orchard, KK Hospital, Orchard Central, and UOB Plaza. We have multiples of these vending machines where you can go with your family or your loved ones. Especially kids love this, and they even collect all these cards. But there's also a virtual machine that we used to have at Clark Key and now at McPherson's. But you can go to the website giving.sg or endowus.com and really participate in trying to share the love and give back to the community so that we can all be better together. So just wanted to give a quick shout out to that. You can go to the website and find out more. Also, obviously, we're going to be talking about the Cash Smart solution as compared to all these other alternatives for your cash, short-term money or the low-yielding assets, income products, as we call it, because no matter, even though interest rates have risen, fixed deposits, T-bills, and Singapore savings bonds are all low yielding versus all the fixed income and other products out there. But Endowus is a digital wealth platform. It's the only wealth platform that does private wealth and public pension, which is your CPF and SRS. It's the only platform where you can manage your cash, your CPF, your SRS, all seamlessly on a single app. And we're the only ones that did that. A lot of innovation. We're all about technology and innovation and leveraging it so that we can help individuals be more empowered to do better with their money and their wealth and build it towards their long-term goals, such as retirement. And we use that technology and innovation even in areas like charity. Developing these giving machines together with our partners. But we have a full suite of solutions for investors. So you get what you want, find what's suitable for you. And I hope that today's webinar can provide some insights into how you can do that well. Again, Slido, and then we're going to jump straight in. I mean, we've talked about fixed income rebounding, but we've had a very, very sharp rebound. And I think a lot of it is related to interest rates, the Fed, and inflation. So the natural subsequent question that a lot of people ask us is when and where are interest rates going to be peaking? The Fed is just raised 0.5%. where is the terminal rate? Are they going to raise by 25 basis points? How many more times? When is it going to peak? At what level is it going to peak? So I'm going to touch on a lot of this thing because the past 12 months has been all about the Fed and inflation and interest rates as a result. And we've learned from our experience that we don't fight the Fed. So it would be good to know with a crystal ball what exactly is going to happen. And we've always said that it's impossible for us to predict the future in anything, let alone financial markets. But I think we can have an educated guess, and there's a lot that the market is telling us right now. So we'll go unpack this for you today. Okay, so first of all, how did we get here? A timeline of the major events that brought us to this new inflationary environment, this new environment of very high interest rates, which is bad for people who are borrowing. So we suffer from mortgage rates and having to pay much more. But if you're an asset owner, then obviously you also benefit because you can get high interest rates in deposits and T-bills and in fixed income as well over the long term. It really started with COVID. And in response to that, central banks and governments, because fiscal is government, and monetary stimulus from central banks have been unprecedented. And so the increase in liquidity, the increase in handout checks, and a lot of the positive, stimuli have been coming very quickly. And that led to really a glut in liquidity. And that obviously fueled rising asset prices and inflationary expectations as all financial markets kind of melted up, including things like crypto and risky assets. The economy continued to power ahead after a strong rebound. Unemployment rates continued to fall and prices continued to rise. And on top of that, we had the shocks, the supply shocks of Russia invading Ukraine, the COVID, and supply chain, which has started to recover now, but with demand remaining relatively strong. That has led to major outbreaks of inflation, which has become much more sticky. And as a result, the Fed, which was behind the curve and a bit late to the game, has had to increase rates very, very rapidly in an unprecedented manner. So where are we? The Fed has now, in the December meeting just a couple of days ago, raised the final increase of the year at 50 basis points, 0.5%. Which has taken us to the 4.5% threshold, 4.25 to 4.5. And this dot plot is what the Fed committee, all of its members kind of plot where they think the FOMC and the Fed funds rate should be in 2023, at the end of 2024 and end of 25, and over the long term. And so you can see that eventually we have interest rates coming down to the long-term averages, maybe slightly higher than average, but a lot of divergence, maybe less so next year. Everybody wants to be hawkish, but going into 24 and 25, you see that massive divergence between people who think that interest rates should remain at 5.5 to 5.75 for 3 years running, which is a pretty ludicrous, extreme example, versus some people who think that will already be down to 3% by the end of next year and the 2% level the year after. So I think there's a broad divergence even within the Fed, and obviously the market is also similarly very, very divergent. I showed this chart in the third quarter performance review a few months ago, but the effective Fed funds rate is the blue line. And I say effective because the Fed always talks about a range now. So it's 4.25 to 4.5%. So I put 4.5% for December, but obviously that's a range. The effective Fed funds rate currently is only at 4.3. So the black line is interesting because that's the 1-year Treasury market yield. So the financial market trades the Treasury government bonds and sees where that 1-year Treasury bond is priced at in terms of yield. And you can see that the market has always moved ahead of the Fed. Even when interest rates were at zero, they were pricing it at 0.78% to 1%. And since then, it started moving much faster. If you look at March and April, it moved up to 2% when Fed fund rates were already at 0.3. So they knew that with inflation coming, that we need to move, and the Fed was behind the curve. And ever since then, the market has continued to move ahead of the Fed's actual action. So even though the Fed has increased, the market has already moved ahead of it. And we are affected by the market yield, not the Fed funds rate. So it's interesting that that gap has continued to narrow from 5 months ahead of the Fed to 3 months to 2 months. And in just like the last 2 months, the market has actually priced in that we are almost there in terms of the Fed hike. So we reached almost 5% in terms of market yield, and then dropped to 4.75%, and then now 4.65% at this current juncture. And the effective Fed fund rate is at 4.3. So what they're pricing in is maybe a 25 basis point hike in the next meeting, which is in February, and maybe another one in March, and that's it. So that's what the market is pricing in. So we're almost there. So I think that globally, the Fed raised, the ECB raised, and Bank of England all raised that in a matter of a couple of days. And everybody has been hiking very rapidly. And I think the US and the Bank of England are probably the most advanced. And I think they've clearly signaled that they haven't clearly signaled it, but I think we're almost at the peak of interest rates in this current cycle because we're way above where we were in previous cycles. And I think what's also changed is that inflation, after continuing to surprise on the upside constantly, we've finally seen some surprise to the downside. So a negative surprise or positive in our sense is the smallest month-on-month increase in the U.S. core CPI in 15 months. So 0.2% in terms of the CPI, headline CPI, and 0.1% in terms of the core CPI month on month. And these month on month increases are important because the year on year effect obviously is going to continue to decline, but the month on month shows us the momentum of inflation. And that momentum, after reaching almost 0.8% last year and the middle of this year, is starting to wane. And that's a very, very positive sign. And this chart, again, I shared last time, but from Bank of America, clearly shows us how that inflation trajectory will play out. So if we had assumed that core CPI remained at that 0.6% month to month for a long time, then we would have inflation even in the middle towards the end of 2023 at 6.9%, which is a very high number. And the Fed will continue to have to raise interest rates even higher. But we have actually seen that coming down to 0.4 initially, which means that if core CPI continues to be 0.4% for the next 6, 12, 9 months, then we'll reach a 5% year-on-year number. But now we're down to 0.2. So if we use 0.2 and 0.1 in the last month, but let's say conservatively 0.2, then the year-on-year number will start falling quite rapidly because of the base effect that we have. And we may have a little bit of a blip in January, February, where the increase wasn't so much, but then it will gradually come down throughout next year to a 3% handle, which would, I think, surprise the market on the upside. And I think what's important is that in the backdrop to that is how the economy fares, because what is the worst thing is to have stagflation, which is a stagnation of economic growth and high inflation. And that was the concern at the end of last year coming into this year. Now we're seeing inflation come down, so the risk of stagflation has receded, but the stagnation in economic growth is the concern. So slowdown in economic growth is a concern. And I think that, we see some signs of that, property prices coming down, retail sales coming down in the US. But on the flip side, labor seems very strong. So I think there is some concerns that there is some sticky inflation in certain aspects of the economy. But overall, the rising interest rates, the rapid rise in interest rates are eating into consumers' wallets. So we have less money to spend because mortgage rates have increased and we have to pay mortgages, especially on floating rate, much more. It's almost a tax in, our spending. And so I think that overall retail consumption has started to come off in the US and other parts of the economy. And the revenge travel, the revenge spending, I think is starting to ease off. And as a result, I think there is a much more muted growth that is likely to be ahead of us. And that is good for inflation. But obviously, it's also a concern for markets because we saw the market react negatively in the past 2 days because they said that, hey, then if the economy slows down rapidly from here and maybe goes into a full recession, then we're going to see earnings and top line growth decline with inflation remaining relatively higher for longer. So we need both of that to reverse, or one to play into the hands of the other. And this is where I think the debate between equities and fixed income becomes much more interesting. But what's interesting is, again, the market. What is the market telling us? Because the market is the amalgamation of millions of people around the world pricing in all the relevant data that we have. And the bond markets are starting to move ahead of the Fed and beyond the Fed speak. So policymakers and politicians obviously have an agenda. And the Fed's agenda is to crash and burn the inflationary expectations of the market. And that includes corporates, government officials, and individuals who actually contribute to that inflationary expectation. And that will lead to corporates jacking up prices, individuals, also asking for bigger wage increases so that they can compensate for the increase in inflation. So I think there's that inflationary expectations need to be broken, and so the Fed is going to talk very hawkishly for as long as possible, and they'll raise rates if need be a little bit more, depending on what the data is. If inflation comes off sharply, then I think the rate hikes may be done or will be almost very close to being done. But what the market is telling us, taking all that economic data on the growth side, consumption, interest rates, and the effect it has, and normally interest rates is a blunt tool. It has a lagged effect to the reality, the real economy, and people's actions. And so we're starting to see that filter through because the increase has been so rapid and the impact is big. So now that the market's impacting the economy, the market is telling us that actually they think the Fed will probably cut interest rates probably from the middle of the year into the second half of next year because the economic growth is going to be slower. So this is also a two-sided coin. Growth being slower means that the Fed will cut, but earnings and numbers that we see and growth may be weaker than expected. So there may be a Goldilocks scenario, what we call a soft landing. That's what the Fed is trying to engineer. And there's still hopes, I think, in the market that that may be possible. But at the moment, the market's starting to, you can see that the red line, especially towards which is the end of 2024 versus 23 number, people are expecting the rates to start coming down quite rapidly. Okay, as a result of that, the bond market has rallied very strongly. So it's added about almost $3 trillion of value in just the past, couple of month and a half, and that's a 10% rebound, which is phenomenal. And a lot of a lot of bond and fixed income markets and across geographies and across the risk spectrum and across duration have seen a decent rebound in the past month and a half. One other thing that has contributed to that rebound, especially for emerging markets, we know the US very well, but people have started to focus on the fact that emerging markets and Chinese fixed income markets have actually rebounded. The credit stress levels that Bloomberg publishes for onshore, which is China internal debt denominated in renminbi, as opposed to the offshore, which is the US dollar denominated debt. That's also the risk from a very high level for offshore has come down, and onshore has come down dramatically, especially as the Chinese government starts relaxing regulation, has started to ease policy. And one of the key sectors that have benefited from that is the developers. So there's been a massive rebound in China bonds, but especially the property bonds, which basically cratered last year. And there's been a massive rebound in just the last 2 months, which is about 65% rebound. And that has contributed to Asian bonds and emerging market bonds and China bonds, recovering somewhat. Just a quick recap here for those that are less familiar with the effects of bonds. So there's two things that drive bond returns or fixed income returns. One is the actual interest rate or the coupon or the yield that a fixed income product gives to you for lending for you lending them the money. Whether it's a company or a government, you lend them money and they would build something or they'll invest or spend that money to operate the company. And as a result, they give you an interest rate. And if you're a safe government like Singapore government or the US government, then the bond rate is the lowest. And then from there, the safest, you would add spreads. further interest rate add-ons for the risk you're taking incrementally. So a good company is an investment grade, a bad company is high yield bond, and then outside of the US or developed markets into emerging markets and especially China type, risky geographies and countries will command a higher premium or spread to the interest rates of the US Treasury government. So that is the first piece. But the second piece, especially because bonds are traded and bonds have liquidity and people buy and sell bonds. If it's a 3-year bond, within that 3 years, people buy and sell the bond because they want a tradable market and they might need liquidity and they're buying it for investment purposes, especially if you're a pension or sovereign wealth fund, you have certain asset allocations to fixed income. Some of it you may hold to maturity, but others you may trade it. And people will do that. And so there's a capital gain portion where the price of bonds can rise and fall. So the bond is issued at 100 and matures at 100, but in between it fluctuates. So this chart kind of shows you the inverse relationship between interest rates and bond prices. It's an exact one-for-one kind of replication where one increase in interest rates is a one fall in bond prices if duration is 1 year. So there's a third factor, which is the duration of the bond. And so interest rates rising means bond prices fall, which means that new bond issuances will come at that higher interest rate, but the existing bond prices will fall. And as a result, you have a capital loss. That was the cycle that we experienced throughout this year, with interest rates rising, that green line, with bond prices falling. So right now, we're seeing a lot of attractive yield, a lot of bonds priced in the right way, but bond prices are really low. So if interest rates start falling, bond prices will rally. So the increase that this is a perfect spot to be investing in fixed income and bond products because you're getting higher yield than before, and you have the upside of capital gains if interest rates start falling. So we don't know exactly where we are in this cycle, and you never know. Inflation surprises on the upside, interest rates go higher, then maybe it's a bit too early. But generally, I think the consensus is starting to be seen, and the recent market movements have shown that people are attracted by long-term interest rate being much higher, and that's compensating for the additional risk that we're taking. So I think that's really important to know. And it's especially important because the Fed rate hike cycle, this cycle, and sorry about the title in the middle about China profit, and that's wrong. We'll delete that. But the US Fed fund rates versus every other rate hike cycle that we've seen in the past few decades, this is the fastest that we've seen. So the incremental increase in this cycle has been the fastest. And this is kind of the cycles that we live in. It's very fast cycles. COVID, the market fell 30%, rebounded very quickly. This year, we've seen massive drops in markets and very quick hike in interest rates. And that's why I think that, it's important for investors to be aware where we are because things change very dramatically. So at this point, now that we've addressed the macro, we've addressed interest rates, we've addressed fixed income markets overall in general, I think let's go to the short end of that, the liquid cash cash type products that we have, because I think people coming out of COVID have had very high savings rate because we weren't spending a lot of money and some government handouts happened. Generally employment has been relatively high. And so there's been more surplus savings and people have more cash and people are looking to get higher yield because interest rates are high. So there's been a lot of interest and flood of money going into fixed deposits, T-bills and SSBs, which shows that there's a lot of liquidity, but also there's a risk averseness because markets have come off and then interest rates have gone up. So all of that triple whammy is coming together to drive a lot of money into these sectors. But what are these things and why you should be interested and what is the best way to manage investments? And I'm going to throw one more in there, which is the Endowus Cash Smart solutions. And we have 3 of them, and there's 3 for a reason. And so let's go into the details. This is a table that I created for all of us so that we can look at it in one go. And we can go through each of the most important issues, most important categories or factors that we should consider when we look at these various products. And I've lumped Cash Smart Enhanced and Ultra together because that has some short duration bonds in it, and Cash Smart Secure is separate because that's a very safe institutional deposit and money market funds where you're unlikely to lose money. And that becomes a very interesting product. So it's similar to the other three products on the left, which are Singapore savings bonds, Singapore government T-bills, and then the bank fixed deposits. So the green are the positives. So out of all these, 5 options, which one has the strongest kind of attributes for that particular factor? I highlighted in green. And then red is something that is negative or something that is a risk factor, something that you should definitely know, but many people may not know. So let's start from the top. Capital guarantee. Everybody asks this question that yes, bank deposits are insured by the Singapore Deposit Insurance Corporation. But if you need to have Singapore Deposit Insurance Corporation, I always say that, and that's a scenario when Singapore goes bankrupt. When all of DBS, UOB, and OCBC go bankrupt, that means that Singapore is bankrupt. So I feel that SDIC is something that is great to talk about, and it's a safe safe thing that gives us peace of mind. But effectively, it's never going to come into play. And it was created in 2000 post the global financial crisis to give that kind of comfort, and globally everybody adopted it. But it's not something that's going to, I don't think DBS or UOB or OCBC is going to go bankrupt anytime soon and lose your fixed deposits or any kind of bank deposits. So yes, it is there, but it's not much of an added benefit. And what people don't realize is that Singapore government T-bills and Singapore savings bonds are not guaranteed. It's actually backed by the sovereign rating of Singapore, so it's super safe. But likewise, Cash Smart Secure is very safe and has not had a down day throughout 2022 when fixed income markets have gone badly. Cash Smart Enhanced Ultra, obviously you're exposed to interest rate risk and credit risk, and therefore you have capital losses. But Cash Smart Secure has had no capital losses. Now look at the yields. Fixed deposits are around 3 to 4%. Singapore savings bonds are 2.95% to 3.3%. So in fact, Singapore savings bonds is probably the most unattractive in terms of yield. Singapore T-bills are now up to 4 and 4.2 in terms of benchmark yields. But obviously, if there's a big demand and a lot of people go after that T-bill, like in the auction, like the previous month where it drove down to 3% handle, then I think that, it's something that we don't know. Cash Smart secures at 3.4, 3.7, but the Fullerton Cash Fund, which is half of it, you can buy separately, and that's now yielding 4.2%, which is even higher than the 6 months, similar to the 6-month Singapore T-bill kind of range. And then if you want to take more risk, you have Enhanced and Ultra at 4 to 5% yield to maturity. And on top of that, as I explained, if interest rates start falling, this is going to give you the oomph. This is going to give you the capital gain that will boost the return. So if you look at the performance over the last, and I'll share more details later, if the past performance was about 1.5 to 1.7%, that's an annualized return of 10 to 15%, which is phenomenal. And so I know that it's been a painful process for people who have held on to it, but I think there's light at the end of the tunnel, and we've had a very strong performance last 1 month. Yield type, I think, obviously the fixed on the left versus the floating on the right. So as market rates continue to go up, if you had locked in a fixed deposit at 6 months or 12 months of 2% level because you thought, wow, we're back up to 2%, 3%, then you're kicking yourself because now it's at 3, 4%. And you have to pay a penalty to remove it from banks so that you can put it into a better fixed deposit rate or buy T-bills. So you effectively gave up all of that return during that period that you could have had in Cash Smart Secure. But the most important thing is that, T-bills, I think it's an auction. It's not a fixed number. So you don't know what you're going to get until you actually participate, put the money in, and then afterwards they will tell you what the yield is. Even the benchmark yield is just a guidance. It depends on demand and supply. If there's too much demand, yields will be lower. So you have to understand that. Now the lockup, fixed deposit obviously is the worst. Cash Smart, obviously zero lockup, daily liquidity. You can actually take it out anytime you want. You can put it in, a few days later, take it out. Obviously there's a transaction period, but basically, it's the most flexible, most attractive kind of in terms of the lockup and flexibility you have. Singapore T-bills, you have to understand, like Singapore savings bonds, we'll talk less about, but there's no penalty for early withdrawal, so it's actually not bad. but the yields are too low. Singapore T-bills yields are good, and you can actually trade it like any other bond, but there's very high cost involved and there's low liquidity, and therefore you're going to have to be penalized for that. And so effectively, T-bills and Sing saving bonds, the longer you hold it, the better. Um, Whereas fixed deposits, the same thing. There's a lot of penalties if you have to withdraw it and you need the liquidity. So make sure that you have the money that you need so that you don't have to break this. And duration, most flexibility, obviously, cash smart, secure, and enhanced. Great yields with just days, which are daily accumulated versus and as long as you want. Sing savings bond, again, you start with 1 year, but that's a low interest rate, and then the longer you hold, you get high interest rate. That's good. And T-bills is just two choices, 6 months and 1 year. The application time is something people don't talk about, but there is a period where you're going to have to take money out and have nothing, no interest on it for up to 14 days or a month for Singapore savings bonds. And you get auctioned for T-bills, and then for 3 days, you obviously get nothing, and then it kicks in. And so there are days where the processing means that it will take time and time out of the market, time where you're not being paid interest. And that adds up almost to 0.1%. If it's like for the 2 weeks. If it's a month, then it's obviously a big impact to your and so Singapore savings bonds, you should actually whack your yield even lower because you're out of the market for almost a month. CPF, yes, the only ones that you can invest is Singapore T-bills. So cash smart secure cannot be invested in CPF, but you can invest in certain funds like UOB, SGD, or low short duration fixed income type products. But obviously, I think CPFOA, we always say, should be invested for the long term. But also T-bills, I think there's a lot of people using T-bills saying that, 4% is higher than 2.5, I should go for it. But there's also an extra cost of transaction. So there's $6.5 in total when you go in. So it's $2 per transaction. So buying, and then another $2 when you sell it. And then CPF uniquely for T-bills has a $2.5 quarterly fee, which adds up. So if you have it for 1 year, that's $10. So there's a lot of dollar fees that are going to be incrementally added on, which may take on another 0.1 to 0.2% off that yield. So those are things I think definitely you should consider. And this is why Cash Smart Secure and Cash Smart Enhanced look so much more attractive, because you have liquidity, you have no lockup, you can invest in days or weeks or months or years. It's pretty effective. You have low minimums of $100 if you're an existing investor. There's no maximum, no transaction fees, and you can yet get yields of up to 4% or 5% with some positive impact of capital gains if interest rates fall. So it's been a tough market. It was really great in 2020, 2021 to be in these cash smart portfolios because it was giving you good yield and some capital gains, especially if you were in ultra and enhanced. If you're in secure, then it was much lower yield. But you can see that the curve is starting to increase now for cash smart secure as the interest rates have risen. And enhanced and ultra, which were massively impacted by the rising interest rates and the impact of duration, falling prices, have now started to rebound, and ultra obviously has rebounded the fastest. So year to date is narrowing the losses. And we're looking at the underlying compositions, and we've built this 3 products with the right type of portfolios. Cash Smart Secure is Fullerton SGD Cash, 100% institutional deposits from banks with high yield, very short duration, just literally weeks. And then short Lion Global Singapore dollar enhanced liquidity, which is a like money market fund that's amortized. So the returns are very stable and not going to be lower. And Fullerton Cash is now yielding above 4%, and enhanced liquidity for Lion Global above 3%. And then for enhanced and ultra, we've been rejigging and building portfolios so that you can take more risk and have more return in a normal environment. And if you look at the underlying portfolio funds that have driven cash secure, enhanced liquidity, and Fullerton Cash, obviously very stable returns, but Fullerton Cash was 1.2% during that period in the second half of this year alone. But we've had some, that have been very painful, but also PIMCO low duration, which has given you relatively strong returns during that period. And as a result, the 3 products since the bottom have rebounded. Cash Smart Secure has been very steady, 0.3%. So in 2 months, less than 2 months, it's gone up 0.32%. And you can annualize it by multiplying roughly by 6-7 times. So you're looking at like 2% plus for Cash Smart Secure. Enhanced is going to be like like 3% plus, and Ultra you're looking at close to 7, 8, 9, 10%, depending on where you look at it. And if you look at the underlying fund performance, individual funds, you can see what they've done exactly as they should. And I want to plot this against the Endowus fixed income offerings, because we have this cash short liquidity product, Secure Enhanced Ultra. We have low volatility fixed income. In satellite, we also have China fixed income, if you want to be very high beta, which is going to be really high risk. Flagship, 100% fixed income. In between, we have the income products, but that's built as 100% fixed income, 80-20, 60-40, but it's not 100% traditional fixed income. So that's why I haven't really highlighted it. But in terms of the risk and return spectrum, you should understand that this is very correlated, that the more risk you take, the higher the return is, but also the risk of loss is going to be higher in the downturn. So we've had that upturn in 2020-21. We had the downturn in 2020, and now we've seen a strong rebound. And if you map that out in the various scenarios, you saw the downturn in 2020 and 21, the rebound from there onwards, you see up and then down, up, down, up, down, up in the recent rebound. That effectively what we've shown you is Cash Smart Secure, Enhanced, Ultra, fixed, low vol fixed income, and the flagship 100% fixed income. So the difference is the duration, and as a result, the risk, and as a result, the return or the yield. And that's perfectly correlated. In every cycle in a downturn, the Cash Smart Secure is always slightly positive, right? We've never had a negative period. Even in the downturns, Cash Smart Secure has always been positive. But Cash Smart, Enhanced, and Ultra obviously fall a little bit more and rebound much faster in an up scenario. And then low vol fixed income and 100% fixed income, even more than that. So we've shown this throughout these cycles. So we at first showed like 4 charts, 5 charts, 6, 7, 8, now 9 charts to show all the cycles, and it's consistently been exactly as it should. It's been consistently as we've designed it, so that the higher risk portfolio gives you better returns in an upturn and gives you a bigger fall in the downturn, and the safer stuff on the left remains less volatile, and Cash Smart Secure is always positive even in downturns, which is what it should do. So I think you need to understand the construct of the various products on the Endowus platform so that you can take as much out of it as you will and use it in the right way. Now, this chart, I'm just going to update with one more chart, which is not here, which is the March 2020 COVID. In between the COVID-19 and Delta variant on the left is a period of almost 1 year, from March 2020 to February, March 2021. And I wanted to add that in, because that rebound is the pandemic bull run, is what we called it, is the rebound after the sharp falls. So COVID-19 was a period that was very similar to 2022, where equity markets and fixed income was highly correlated. They both fell double digits, and everybody was shocked that fixed income fell so much. And then we saw the rebound, and we saw how the fixed income market continued to rally, as did the equity market, which is even more risky and volatile, but gave you tremendous upside in returns. And I think that this market rebound, it may have another downturn and then an upturn and then a downturn, upturn. But when that upturn comes, and it may be now, then obviously that's the kind of returns you're looking at, because this previous chart was pegged at 10% and we barely crossed 5% in any of these rebounds. But that big rally over a period of 12 months gave you almost a 20% return in terms of 100% fixed income and 5% type returns for Cash Smart Ultra, which is even higher than anything you can get out there. So this is why you need to understand how fixed income markets work, how duration can be in your, like, against you when interest rates are rising, but be a massive tailwind and for you when interest rates start coming down. And inverted yield curve is giving us a short-term opportunity. And this is why a lot of people focus on short duration. And, you're looking at short duration bonds because they're giving you higher yield and giving you better risk-adjusted return. That's where people focus. But you can see that the blue to the green is the latest move in longer duration. So out from 1 year beyond, the blue and the green have crossed down. So while short interest rates continue to rise because the Fed increased it, the long duration actually started falling. So we're actually lower in interest rates from 2 years beyond since September. Just 2.5, 3 months ago, interest rates were higher. Now it's definitely lower across the whole spectrum of 2 years, 5 years, 10 years, 15 and 30-year bonds in the US Treasury curve. What that means is that that's what's been driving fixed income returns because that's resulted in capital gains as interest rates have fallen. What it also means at the short end, there's tremendous opportunity if Fed stops increasing interest rates, and that's not going to do anything for you. You're just going to get the yield of 2% or 4%. But once it starts falling, that's going to give you massive oomph in terms of giving you extra returns in terms of capital gains. So just wanted to understand the move of the Treasury yield curve and how that impacts not only yields, which is the interest rate itself, but also the capital gains that we can gain from it. And with this move, projected yields across Cash Smart, Secure, Enhanced, Ultra has continued to move higher. And people complain, hey, how can these keep going up when the performance has been bad or it's been negative? But it's exactly how it should be because interest rates continue to rise and the market rates continue to track it. And as a result, Cash Smart being an amalgamation of underlying funds which are driven by market rates, they have continued to rise and have gone beyond most people's expectations. And they're at very attractive levels. And I think there's room for that to continue to increase a little bit more from here. And if you look at the underlying underlying funds of these portfolios, you can see that the gross yields, and we have to adjust it for fees and the management fees as well. Endowus for cash products only charge 0.05%, virtually nothing. And you get more than that back in terms of trailer fees. And therefore, it's an attractive product. But underlying, you can see that Cash Smart, underlying funds like Fullerton Cash is at 4.2%. United SG is at 5.65%. PIMCO low duration is up to 8% because US bond prices have fallen so much. The yield to maturity is up to 8%. The yield of the portfolio is at 4.5% in terms of income payout, but the yield to maturity, if we hold all of those bonds to maturity, the average yield now, because the prices have fallen, is 8%. So the underlying funds are also providing attractive yields. And what's more important is that bond yields have shot past equity dividend yields. So this is S&P 500 versus the Treasury and corporate bond yields, which have spiked up. And if you look at it beyond the US and look at it across a broad spectrum of sectors, US high yield is now at 9.7%, emerging markets is at 9.6%. And so, there's attractive opportunities that are opening up in the fixed income market as prices have come down, yields have gone up, and spreads have blown out. And just to give you a highlight, the single money market funds on Fund Smart. Now, Fund Smart is an Endowus platform that allows you to buy unit trusts or mutual funds at the lowest cost here in Singapore. So it's cheaper than Fund Supermart, Doladex, Poems at Phillip, and definitely cheaper than any bank or broker out there because we're the only platform that gives you 100% cash back on all the trailer fees. Trailer fees are the embedded fees that are commissions paid to the banks and brokers and to iFAST, Fund Supermart, Phillip, and Poem. And Doladex, they live off of the hidden fees that are embedded into the funds that are paid to the distributor. So we get trailer fees as well. And it's typically up to 50% of the cost of the fund. So if the fund is 1%, you're paying 1%, and 50% of that, 0.5%, is being paid to Doladex, Poems, and Fund Supermart. And that's how they make a living. They say zero sales charges, zero fees, but that's how they make a living, which is the kickback commissions that they get from the fund managers hidden into the fees and taken out of your NAV. So you pay for it, but they get it without you even knowing it. We take that and we give 100% cash back to our clients, and we don't keep a single cent. We're an independent fee-only wealth platform as a result. And when we sell you a fund, we get all the trailer fees as much as we can and give it back to you, generating better returns and lower costs for all of our clients. Now, if we bucket these single funds into three different buckets, one is the money market cash funds. So you have Enhanced Liquidity Fund from Lion Global, you have the Fullerton Cash Fund, you have the Lion Global Money Market Fund, and the UOB Money Market Fund. So the four choices on the Fund Smart platform. These are the best ones out there. Among them, you can see how they performed historically, but Fullerton Cash Fund also gives you the highest yield right now. So Enhanced Liquidity used to at 3 point something percent, now it's 4.2% in Fullerton. So if you're buying a single fund, this is the one you should buy. If you look at the short duration bond funds, we have a choice of, let's say, 5 here from Fullerton, Lion Global, UOB, and Nikko, all of the local fund managers. Among them, the one that gives you the highest yield right now is the United SGD Fund, which has a great long-term track record, has struggled over the past year or year and a half because of its exposure to Asia, China, etc., and rising interest rates. But that now, among all the short duration, is giving you 5.7%. So if you want some exposure to short duration, that's a good choice. And then obviously, the other one that is the kind of the more risky short duration bond funds. Among them, we have Alliance Bernstein short duration high yield. We have Neuberger short duration emerging market. We have PIMCO low duration income, and then Dimensional short-term investment grade fixed income. So they're all short duration, but more global in nature, whether it's US focused like PIMCO, or more global like Dimensional and Alliance Bernstein, and sector specific in terms of Neuberger for emerging markets and Alliance Bernstein for high yield. And I've given you the yield to maturity for these, which is in the 5% up to 8% for PIMCO. And among them, PIMCO is obviously the highest yielding. And then if you go to 100% fixed income products, obviously there's a whole list that I can't share with you. But if you want to go into the Fund Smart platform, it is the most attractive platform to buy a single fund. You can actually now activate fund asset transfer. So if you have funds in Fund Supermart or a bank like Citi or any of the local banks, or a broker, or Poems or Philip or Dolodex, you can actually just move the fund over to the Endowus platform and immediately take advantage of the trailer fee rebates. So we have exclusive funds for both retail and AI investors, like the Amundit passive index funds. That is 5 basis points starting. We've just onboarded the BlackRock iShares passive index funds, S&P 500 with 0 withholding tax at 8 basis points, and global developed markets at 12 basis points, and fixed income products are really wonderful. Those are good options too. But you can have access to more than 200 funds among some of the leading global fund managers, and you can use the filter tool on the left to search for it, and it will in most cases be the lowest cost way to buy and maintain or invest in funds, mutual funds and unit trusts here in Singapore. And the investment office does a lot of work to give research. You have these comparisons tools here so you can compare and analyze, and a lot of research in there for each fund. If you click on it, there's details of why we chose the fund, what this fund is supposed to do, what are the performance, the fees, the overview, the risk, etc. So there's a lot of content in the Fund Smart platform that I hope everyone can use. Now, finally, I just want to give a shout out to Keith and the Investment for Moats Financial blog, a very important partner that we like a lot. Keith does some wonderful research on Investment Moats blog, so please subscribe to that and follow him. And also, he actually just published, I think just a couple of days ago, something on this subject, which is the Money RY Saver Money Market Solution, which is yielding 4.2%. And the reason it's 4.2% is because that product, unlike our products, which are mixed, you can buy a single fund. It's 100% Fullerton Cash Fund, the fund that I've been speaking about. So Fullerton Cash Fund has a SGD fund and a US dollar fund. And the SGD fund, as I mentioned, is yielding 4.2%. Unfortunately, Keith just mentioned that you can actually buy it on single fund platforms like iFast, Fund Supermart, Poems, or Dolodex. But he forgot to mention Endowus, because we are actually a fund platform as well. And therefore, and we are actually the lowest way to buy any funds, including the Fullerton Cash Fund. So it's the same cost as Money Owl, but it's cheaper than Fund Supermart, and it's cheaper than Dolodex, for example. So Dolodex, I don't know why, they have a management fee of 0.25%. I don't know how they calculate it. But Fund Supermart is the one that I really want to highlight. People don't realize this, but they have a fund platform fee. So even if you buy a Singapore dollar cash fund from Fullerton, you not only pay the management fee of 0.15%, you actually pay 0.05%, not annually, but per quarter. So that's 0.2%. And for all fixed income products, you pay this fee. So on top of the 0.15%, you're paying 0.2%. So that's a total of 0.35% for fixed income, Fullerton SGD cash fund. So it's the most expensive way to buy a fund is Fund Supermart. So don't ever touch that. On top of that, if you buy an equities fund, it's even more expensive because they say it's 0.125 or whatever the fee is. It adds up to, I think, 35 basis points, 0.35% in equity fees. But not only that, Fund Supermart, Dollar Decks, and Poems all live off of the trailer fees, which is the not transparent way to sell funds because they get a kickback from the fund manager, which is often more than 50% of the annual management fee. So I always give the example of the most popular income fund, which is PIMCO Income Fund, which is also very attractive right now. So PIMCO Income Fund, and all of these platforms are sold at 1.45% annual management fee, of which half goes to the distributor. And as a result, if we actually access the institutional share class fund, the PIMCO Income Fund is only 0.55. It's actually less than half the price. And on the Endowus platform, we give you exclusive access to the institutional share class of PIMCO Income Fund. So on our platform, it's only 0.55%. So even if you add the platform fee of 0.3%, which is less than Fund Supermart even, is 0.85% versus the 1.55% plus the 0.35% platform fee that you would pay on Fund Supermart. So it's a fraction of the cost. So any fund you have, especially the PIMCO range of products, you should move it over to the Endowus platform because it's going to be at least half the price. And that is important because that compounds over time. You can get an extra 1%, extra 0.5% return completely for free. Why you should be paying that platform for giving you poor service and ripping you off, basically. So anyway, strong words, but just wanted to share because I feel very strongly that trailer fees is something that we should remove from the industry. And I hope that regulators can affect change over the long term. But for now, Endowus is going to continue to lead the charge in being transparent, independent, lowest fee, as much as possible, and being transparent. Now, the final piece is obviously the flagship and income portfolios, because those are wonderful products that are built in Endowus advised portfolios. The flagship 100% fixed income, or you can actually balance it by saying, hey, equity markets may bounce, and therefore I'll have about 20% allocation to equities, 80% fixed income. This is the portfolio of choice for Greg right now. So just wanted to let you know that 20/80 or 40/60 balanced portfolios. I think many people have talked about the death of balanced portfolios, but 2023, I think maybe we'll be surprised because even in a recessionary scenario, if interest rates start coming down, fixed income is actually going to outperform equities. So there is a scenario where fixed income and equities both do well, which would be great. But there's a scenario if there's a recession and interest rates come off that fixed income does well while equities doesn't do as well. Or we'll see how the 2023 plays out. I just saw this cartoon and I thought it was funny on the Charles Schwab website and somebody sent it to me. So bonds are so in right now, which is very surprising because people don't think about it. But there's been a lot of flows into bond ETFs, especially in US. And I know that talking to institutional investors, there's been a lot of reallocation away from equities, away from even private and alternative asset allocation, which has done really well in this environment and has defended returns very well for a lot of them. And as a result, they've outperformed and they've gone overweight. They're rebalancing it back into fixed income. And so there's been a good flow of fixed income buyers, whether it's US Treasuries or emerging market bonds more recently, that is driving returns somewhat as well. So it's not just a fall in interest rates, it's also sentiment and also flows, which is important. And bonds seem to be benefiting from that tide change. So finally, I just want to say that if this is available on YouTube, so you can watch again. But if you need any help in terms of onboarding with Endowus or in your investment journey, we're a hybrid model. We have 15 dedicated MAS licensed client advisors who are here for you. So please reach out either through support@endowus.com, or you can actually set up a call, 15-minute advisory call with a licensed representative. and you can book that on the Endowus website, or you can, use WhatsApp, Facebook Messenger, etc. as well. So please reach out to us. There's also a weekly Friday session where we go through how to onboard and answer any questions from you. So please join any of those mediums so that you can get to know us better. And then finally, there's a content platform of choice in Singapore. So we've had more than 1 million total unique views. Considering that the adult population of Singapore is like 4 point something million, we've had 1 million people in the last 12 months who've looked at the Endowus Insights page, which is phenomenal. And so it's free content, guys. So please use it to your heart's content. Financial education and literacy is critically important for the future of Singapore and the future of your loved ones and your family. So please help spread the word. It's free sign up. You can get on the mailing list. There's YouTube channels that are on the Insights webpage, or you can go directly to the YouTube channel and subscribe so that you get alerted to webinars like this. And so you can get more educated. So I'm going to jump to the Slido Q&A, and the highest voted is, with the recent Fed rate hike of 0.5% and the higher terminal rate of 5.1, would it be a good time to buy into bonds? Wait until next year. So I just did the whole presentation on that. So I hope that answered the question. I think that it's time to wade back into certain bonds. I think there's tremendous opportunity at the short end, but I think eventually long end is going to be very attractive for us, especially at the interest rates right now. So 2023, I'd be very interested to see how that plays out. Endowus income portfolios versus cash smart. So guys, this is a great question, and income portfolios is completely separate from this core satellite investment framework that we have. We believe that you should be in globally diversified, low cost exposure across equities and fixed income over time to build wealth over the long term, because that's the only way to truly beat inflation. Because fixed deposits is going to certainly give you negative returns versus inflation. If inflation remains high, you want to be exposed into the companies that are listed in the stock exchange, who have pricing power, who are able to give you dividend yields, but also price things higher and generate higher growth and income. That's the whole point of investing in stock markets over the long term. So once things have settled down and interest rates have peaked, and now valuations, after being elevated for so long because of the fiscal and monetary stimulus, have come off, at these valuation levels, things are looking a little bit better and more attractive. And therefore, from this perspective, you should continue to have diversified portfolios. But if you want income, and we have 3 income portfolios that I shared with you. Oh, I didn't touch on it in great detail, but the passive income solutions that we've built are for different stages of life. So stable income is for the more mature, older, you want zero risk, so 100% fixed income, and very stable income, like 4, 5, 6% kind of income yields. And yields have all gone up because prices have come down, and also interest rates have gone up. So stable income, high income, future income started with lower yield income payouts, but now it's going to be much higher. So next year, income products are going to look very, very attractive in terms of the yields it generates. So stable, higher income, which is about 20% equities, future income for younger generation who wants the growth in the total pool of money, as well as the yield that you generate by taking a little bit more risk, is future income. So you have 3 products for the right stage of your life. Please go into the website and get some more details and educate yourself again. We have the webinar when we launched it, but also insights articles. We are updating that right now as we speak. Yulin and Sean Wong actually spoke about it today in the team meeting, but we'll be launching a new webinar and also content around the income product, hopefully in the new year. But please take a look at that. It's a great product, but I think it's not a part of your core investments. It's something that you want on the side for people for specific needs where you need income, passive income over time. Okay, and I would like to protect my capital while earning a regular income, can hold for 10 years. What would you recommend to lock in the current returns of 4%? So exactly that. So stable income is already generating in excess of, I think, 5%. So stable income alone will be good, but depending on your age, if you're in your 40s still and you have a long way to go, then you can have some equity exposure, which is the higher income product. But it also it gives you exposure to higher risk, like higher yield emerging market bonds. And then you have the future income, which is 40%. So it really depends on you. We've given you 3 choices. All of them will exceed the 4% threshold that you expect. And you should not be worried about the capital losses that, sometimes it shows up. These things all fell like 5-10%, less than fixed income markets, but it still fell. So you look like you lost your principal, but as long as you don't realize it, it's okay. And your income, passive income, has actually increased. So you're going to get more payouts from the reinvested money that the portfolio managers will be running. And then from there, as markets recover, as fixed income is recovering, and then eventually equity recovers, you're going to see the capital also increase. So don't worry too much. Income right now is a very, very attractive product. And I think that you should definitely start if you want passive income, like this anonymous question with the 8 upvotes was asking, then any of these products would be suitable for you. Even the stable income gives you that upside, both in terms of capital gains and a regular passive income that's beyond the 4% level. So please check out the income product. Anonymous 7 upvotes is Cash Smart Secure versus only Fullerton SGD Cash Fund. I mean, I love the Cash Smart Secure product, but when the Fullerton SGD Cash Fund is yielding 4% plus, then if you want to be nimble, then you should get the Fullerton SGD Cash Fund because it's yielding higher ratio. But you have to understand that Fullerton SGD Cash Fund has a very, very short cycle. So the duration is only a few weeks, less than 2 months. So what they do is they put the money into institutional bank deposits, esoteric banks like Bank Santander or Qatar Bank or whatever. But they're safe, I mean, because it's very short and they're giving you good yields, and so they're gonna keep recycling it. Remember, Fullerton is owned by Temasek and NTUC. They're 50% shareholders. This is where Temasek manages its own cash in SGD and USD. And so the Fullerton SGD Cash Fund is a very attractive and safe product, and it's giving you 4.2%. And in a rising rate environment, it's going to continue to increase. So 4.2 may become 4.5%, may become 5%. But eventually, when interest rates peak and it starts falling, this is the product that's going to fall the fastest. And then you'll have the longer duration stuff continue to go up. So enhanced liquidity fund will go up. The other UOB SGD fund will go up even more, and the other durations will go up even more. And therefore, you may want to shift from Fullerton SGD to Cash Smart Secure, and then to enhanced or ultra, depending on how you want to look at that. So you have to understand not just the headline yield, but how long you had that yield for. And so it's important for you to keep recycling that. But for now, in a rising rate environment, Fullerton SGD Cash Fund, Cash Smart Secure will both give you rising interest rates, and you can take advantage of that, as opposed to all the other risk-free products. As the next question asks. Risk-free products have higher interest rate than all 3 Cash Smart. Are Endowus going to introduce better products? I don't know what you were watching, but sorry, I think I have to go back to the numbers because I beg to differ. Because Cash Smart Secure and Cash Smart Enhanced already offers better returns than SSBs, Singapore Savings Bonds, and it's better than most bank fixed deposits. The actual bank deposits that you see, apart from the savings accounts where you have to get credit cards, your mortgage, your monthly salary in, you have to take out an insurance, you have to buy mutual funds where you get completely ripped off. All these things you have to do to get to the 7% or 5% or 4%. Savings accounts in general only going to give you 3-4%, just like fixed deposits. So fixed deposits are 3-4%. So I don't know why you're saying that Endowus is not doing as well, because Endowus Cash Smart Secure is at highest 3%. Fullerton Cash Fund is at 4% plus, and Cash Smart Enhanced Ultra is at 4 to 5%. So all of them are at par or better, and it gives you better liquidity, gives you zero lockup. If you, for example, put money into fixed deposit now, and then 3 months later, 6 months later, you actually need the money, then you're not going to get the 3-4%. You're actually going to get much less because you're going to have to pay a penalty for early withdrawal. So it's a trade-off always. Yes, if you're locked in and you have enough money and you want to get that 3-4% with zero risk and Singapore deposit insurance, which I think is pretty much not really going to kick in at any point in time in our lifetime, then you want that, then I think you can go for that. So I'm not trying to bash certain products and just push Cash Smart, but there's a reason why we built the 3 Cash Smart products in this way, is to do exactly what it's supposed to do. And then on top of that, we've given you the choices of the single funds, and we've gone through all of the funds out there, the tens, the hundreds out there, and selected the best ones for you. And we're giving you advice on this as well, because at different points in time, different products may give you better yields and better access to certain sectors, geographies, certain asset classes, certain risks that we take. And so we want to give you as much choice as possible, because the markets always change, the macro environment changes, and so we want to give you choice and give you flexibility at the lowest cost always, and also trying to generate the best returns, best risk-adjusted returns, so that you take less risk and can get as good a return. So I hope that answers the question. Sorry if I was being a bit strong-worded, but I really feel that the Endowus products is phenomenal. Is comparable or better than pretty much everything that I can see out there in the market, and this is why we created the company. This is why we attract the best talent, and the team is working really hard to try to get the best products to you that are often exclusive, as I said, and the best solutions out there and the best advice. Which Endowus products are most suited, Sanford? Which Endowus products are most suited for a macro environment that shifts towards stagflation? So stagflation is an environment where most asset classes don't do well. And so I think that if you look at the example this year of where markets were responding to higher inflation and potentially lower growth, well, we ended up with high inflation and higher growth. But if next year we see, inflation come down and economic growth come down, that's kind of the more likely scenario. But you're saying that if inflation remains really high or continues to go up and the economic growth falls dramatically, I don't think it's going to be possible, because the economic growth and high interest rates is actually going to bring inflation down, as I explained at the beginning. So this chart at the beginning is to give you that perception of where inflation is headed. For it to remain at 6.9%, the economy has to be very strong. So we cannot have stagflation, because inflation is a result of strong growth and strong demand and strong employment. So stagflation can only happen in a cost push environment where commodity prices and the supply side shocks push it higher, and we've already had that. So we need to have World War III, or something that is much bigger, that will have an incremental impact. But in that environment, very few things do well. So fixed income, I think interest rates will remain high, but I think interest rates may, if it's at any point in time stops rising, then it's a positive. I think gold is another one that would do well in a stagflationary environment, because people are going to be protecting assets, and obviously cash is going to be better as a result. But I don't see that scenario really playing out. Would we be subject to withholding tax or estate tax if we buy US bonds via Endowus? But no, if it's a UCITS, if it's a UCITS, Irish UCITS fund, yes. If it's any other fund, for estate tax in US, definitely not, because we don't have any US funds. For withholding tax, only for the exposure that you have in the US. I think that hopefully answers the question. What bond funds would you recommend? I would just buy, I'm retired and need a regular income, 4.5% yearly income. I would buy the Endowus income portfolios, because what it does is buys you several bond funds which have the highest yield. And then over time, if we find better funds, we can replace it for you, and it can generate the highest yield, give you diversification, and manage risk for you at the same time. So I hope that answers the question. Okay, with Cash Smart Secure, current yield is not locked in. With interest rates going to fall in, would you view the options over the long term? Yeah, Cash Smart Secure, as I said, I think Fullerton is short duration. Line Global is several months. Longer duration is maybe a year to year and a half, and then 100 global aggregate index is probably like 6, 7, 8 years in duration. So I think that duration is something you can manage. And so if you're long duration and you are having, like, let's say 5 years, you have 20% of your portfolio, maturing every year, that's your average duration, right? Every year, then you can get that money back as it matures, and you get the money back, you reinvest it in the portfolio, and you reinvest it at the higher yield. And then you lock in for 5 years or beyond. So you just extend the duration over time, and you can lock in the benefit of that yield over the longer term. So I would say with Cash Smart Secure, you just push out to Cash Smart Enhanced, Cash Smart Ultra, and Low Vol or 100% fixed income, and you would enjoy the benefit of falling interest rates because that will give you the benefit of capital gains and also be locked in into the high interest rates of 5%, 6%, 7% potentially. And emerging market and high yield in the US is giving you, as I showed you, 9%. So those yields will be locked in, and also you'll have capital gains. So you have the best of both worlds. I answered the SDIC question earlier, so I'm gonna just, in the interest of time, just skip that. I don't know the Standard Chartered E-Saver product, 3.8%. In terms of returns, I mean, the yield is given 3.8%. Cash Smart Secure is at 3.7. Fullerton SGD Cash is at 4.2. So I would buy the Fullerton SGD Cash at high yield and eventually move over to Enhanced as that goes up. And the Enhanced is at 4% plus. They're all for liquidity. I don't know what the e-saver is. If it's a savings account and you have other stuff that you add on, but I think if you can do the analysis between the products, you'll have a good sense of where things are. Mr. Lu, I might do a session with Lu before the year end if we can. If not, then we'll do one at the beginning of the year. We wanted to talk about the outlook for 2023. So please look out for that, and I'll give you a heads up over time. And you can ask that question to Lu, and I'll try to answer that in that session. Thank you so much. There's no fee, K, I don't know how to pronounce your name, KE, but there's no fee for switching funds. There's no added fees on the Endowus platform. So no sales charges, no trailer fees. We receive it, give it all back to you. No brokerage fee, no transaction fee, no penalty fee, no fee for switching funds. Whatever is fees that are, the CPF charges or other partners charge, we just have to take it because we can't change it. Our fees are very transparently shown, and we have no other add-ons. Sorry, guys. I think in the interest of time, we're going to have to wrap up. I think that this has been a great session. Thank you so much for joining us and staying with us for so long. And I'm just going to maybe, use this opportunity to thank everybody who joined us, but also, sorry, what is the... I think there's a QR code. We turned 3 years old. I think there's a special QR code in case you haven't joined Endowus. For new signups, please scan this QR code. I didn't even know this was in here, so my team put it in to celebrate our 3rd year anniversary. $63 off of fees. And remember, SRS. SRS is a wonderful way to save taxes this year immediately. Almost, how much is it? 18,000 for Singaporeans. 16,000 for Singaporeans. And 36,000 or 37,000 for foreigners. You can save that on tax, lower your tax bracket and save hundreds, if not thousands of dollars this year in tax bill. So please save an SRS. You can have a lot of options, including all these Cash Smart, short duration, cash funds. All of these are available for SRS, but you can also invest in bonds and equities as well. So it's very flexible, and you get immediate tax savings. If you have questions, reach out to our client advisors. For existing clients, there's an even better one. You can win an AirPod Pro, or you can get a $300 cash bonus if you refer 3 friends. So you're getting some extra freebies here today. Three-year-old Endowus is handing out some freebie gifts for new and existing clients. And then once again, it's not just for us. Please help out these wonderful charities that we're supporting through the Endowus Gives Back initiative, which is a corporate social responsibility. A lot of our employees go out and help for these charities and serve them, but also this Endowus Giving Machine, which you can find at Iron Orchard, Gardens by the Bay, Far East Square, KK Hospital, Orchard Central, and the UOB Plaza. In the middle of UOB Plaza, between the 2 towers, we have many of these machines where you can check it out. You can have fun with friends and families and do something meaningful. So please help us. We're trying to raise $100,000, I think, for all these charities, and we want to do our best. So we're really going out there and letting people know. And you can go to McPherson MRT. I think Clarky's already finished, but do the virtual vending machine, or go to giving.sg or Endowus website, Endowus Gives Back website, and log on and donate. The online donations are tax deductible as well. Again, wealth advice, but tax deductible on the online website if it's a big amount. The giving machines are very small amounts, but if you want to donate a more meaningful amount and get tax savings as well, then you can do that on the website of giving.sg. So please go out there and help us as well. Thank you so much, guys. It's been a wonderful session. Please reach out to our client advisors if you have any questions. And we hope that you have a wonderful holiday season and stay safe and healthy. Thank you.